Hey everyone, me Kevin here. Today I'm going to talk about my top 6 favorite growth stocks. Instead of doing a super deep dive onto each stock and putting you to sleep with stock information, I'm gonna give you a very brief overview of these companies, and then I'm gonna give you my thoughts on price and how much of these companies I own. We're gonna keep this short and sweet. I wanna make this as easy as possible for you. I value your time. Quick note, if you have not yet, make sure to check out the pre-sale for the YouTube course linked down below. And of course, yeah, this is a video about stocks, but I'm not a prophet. Nobody can tell you what a stock is going to do tomorrow, and most people won't even give you price targets on YouTube because they're worried about being wrong. I don't mind giving you price targets because that's what I feel, even if I'm wrong in the short term. At least I'm giving you my reasons, but it's always important that you do your own research and determine your opinion of those price targets, and if you think the company has value. With that said, let's get started with number 1. Company number 1, Rocket Mortgage, currently priced at about $23.54. Rocket Mortgage just IPO'd. That means they just went out onto the public market, their initial public offering. And this, my folks, is a totally underappreciated stock, in my opinion. I think the fair valuation for this company is at least $30 per share. It IPO'd for $18. It's now about $23.54. To me, this company still has plenty of room to grow into its valuation today. I honestly, in my private investing courses, during the live stream, when it IPO'd and we had a live stream, I remember telling my course members, like, why is this not going up higher? Like, this company should be worth more. Anyway, it ended up going up about 20% within the next 24 hours, so that was nice, sort of reiterated what I thought, but I do still think this company has a long-run growth potential. So here's the thing, Rocket Mortgage doesn't just do loans, they do things like title insurance and some other services as well. And as a real estate agent and a previously licensed lender, I have to say I never liked Rocket Mortgage by Quicken Loans at first. It was too fragmented for me. It seemed like every week you were dealing with a different lender, a different person at the company that was helping you get that loan done. And to me as an agent, that was always annoying. But what I found as an agent is that, dang, when they get it done, they're pretty fast and they charge like nothing. Their fees were so low. And so it made sense why a lot of clients were flocking to Rocket Mortgage, and they advertised like crazy. Now, when Rocket Mortgage finally released their S1, which is kind of their proposal to the world, please invest in our company, I read this and I finally realized why. This is a company where, because as an agent, it always felt like I was talking to another person at the company, I never really valued them highly. But now as an investor, I look at the other side of the coin and I'm like, wait a minute. The industry average loans closed per month is 2.3. That means an average person in the lending industry closes 2.3 loans per month. Well, Rocket Mortgage closes about 8.3 loans per month per team member. This means the team members are like a factory line. It's like an assembly line. Everybody's putting in their piece and checking off their boxes, and boom, these loans get done faster and cheaper, and they get more done faster, which more done faster is money in the bag. Now, I'm not sure exactly how they came up with that 2.3 average for the industry, but the point is these folks are like an assembly line. And the bottom line is these companies are selling these loans to Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac, they will buy the loans as long as the boxes are checked. We can have whatever story we want, but if the boxes aren't checked right, Fannie and Freddie won't buy them. Well, this company is mastering checking the boxes. Rocket Mortgage tries to streamline this process for most borrowers, with their process also. They've got an app that makes it really easy to sync your assets and your bank statements, which streamlines providing information, it streamlines credit reporting, and it really makes all of these data points so much easier for them to collect, which makes the whole loan process much easier and more desirable for people. So the bottom line is, like, going through a loan sucks sometimes. Now, because of all of these connections, don't kid yourself either, this company markets to its customers like crazy because they can. They know everything about you. They retain about 63% of their customers on purchases, and I bet there are just a lot of agents who are trying to grind away at that, and they get about 76% retention on their refinances. This is really, really good. They're also finding that 75% of people who are using their app to get a loan, the Rocket Mortgage app, are millennials and first-time homebuyers, a demographic that they think is primed for growth in real estate over the next decades. Also, the biggest players in the mortgage market make up 17% of all mortgages. Rocket Mortgage takes 9% of the total. That's more than half of the biggest 5 players combined. That makes Rocket Mortgage a big force to be reckoned with. Now, one of the problems with the company is they're very subject to interest rates going up and down. They do these things called adjustments to their servicing rights called MSR, and that's really complicated. Basically, as interest rates go down, they recognize more assets and revenues. As interest rates go up, they write off some of their assets, and therefore they show some losses when interest rates go up. This is really important because it also makes our company very predictable in terms of when we're gonna see those adjustments up or down based on interest rates. Don't worry so much about that. Here's what I like to look at. This company is on track to make $7 billion in net earnings, which is just like an amazing number, especially with how low cost they are. They're on track to make that earnings figure. And if they do, then this is a company that trades at 40 times earnings. So we're looking at the forward-looking data, right? For a company that more than doubled its revenues in 2019, this is not bad. Excellent growth, millennial penetration, low bankruptcy risk. I've invested about $70,000 into Rocket Mortgage, and I'll probably invest more. Now let's get to stock number 2, Lemonade. Yes, when life gives you lemons, buy insurance. Yes, there is an insurance company called Lemonade, and it has crazy growth potential, but sells at an epic premium. And if you have not yet tried this yet, here's how you can find out why it sells so expensively. Go to lemonade.com and get a quote for insurance. Pick a state that works. They only give or provide insurance in about 27 states. This is an insurance company that works without brokers. So there's nobody for you to talk to other than a chatbot. I'm sure if you really need somebody, there's somebody to talk to. But they deal with claims and pricing your insurance policy through algorithms and chatbots. And by collecting all of this extra data on you, they're able to evaluate how risky you are, and a lot of that information ordinarily gets lost through traditional broker services. Now, I personally haven't been able to game the system to get it to give me different prices, but it is very valuable for an insurance company to collect this kind of data so they know how to protect themselves from their risk. If somebody's more risky than another person, then maybe they can offload that person's risk with something called reinsurance. See, here's how insurance works and the insurance industry works. An insurance company issues you a policy to you, and you pay for it. This company, for example, happens to target millennials, and they make it very easy to get insurance, get quotes, add features that you didn't even know you needed without talking to a human. It's like overwhelming, but it's so cool. Just go to lemonade.com and try it. And none of this is sponsored. I just want to share this very interesting company with you. I love the service, but here's what they do behind the scenes. If they make $100 or they receive $100 of insurance premium from you, they're going to take out a policy called a reinsurance policy, and they're going to reinsure 75% of that value. That means they're only keeping 25% of the risk, about $25 worth of risk. But they're going to pocket a referral fee of 25% for doing so. That means they make an extra $18.75 on that $100. So Lemonade has 25% of the risk, but actually has $43.75 in their pocket. That gives them an opportunity to make more money and advertise more and grow this company to the demise of the traditional insurance companies. This company's goal is to get insurance down to a science where they keep the amount of their revenue as profit steady every single quarter as a percentage of how many policies they have. Now, this part seems a bit odd, because what they do is if their revenue is going to be higher, they'll actually give away the extra to charity. And they do that for brand value to show their customers how great of a company they are. If revenue is below, they'll probably carry those losses forward and donate less in future quarters or years. This is supposed to make their earnings very stable and really turns them into a pure growth company. This company spends $1 on advertising, they bring in about $2, and after 2 years, new customers pay for themselves. The company also expects to lose less than 10% of their customer base because of the massive brand loyalty and the charity nature of this company. Now, everything about this company sounds great, but when it comes to the stock, we've got a couple problems. First, they've got massive share dilution coming in January of 2021. This means you have to be careful because there are going to be a flood of new shares coming in. Think Nikola-style volatility. However, we don't know how much the stock is going to run up between now and then how much is it going to fall? So for example, if it's say at $70 today, is it going to run up to $140 and then fall to $100? So it's still higher than where it is today? Or is it going to fall below today's pricing? Nobody knows because it's still 6 months out. Nikola had a lot of a shorter term window. It was only a 45-day window. That's why you saw this boom crash. And we called that. We saw that coming. I made videos telling you Nikola is going to crash because of the share dilution coming, and that's exactly what happened. However, Lemonade, unlike Nikola, is actually a working company and actually selling a product. And for me, they're going to be a piece of my portfolio. I have about $150,000 to $200,000 in Lemonade. Currently, I'm not planning on adding too much more because I'm putting more money into Rocket Mortgage and company number 3. Company number 3 is Purple. It is a mattress and pillow company that makes buying mattresses and pillows ridiculously easy. I don't know that there's much to that, but they do have some pretty crazy marketing. You've probably seen their viral ads with their egg squishing and like the glass falling on the mattresses. And you just look up Purple pillow advertising. It's crazy. Or go to their website, purple.com, and you'll see a lack of egg squashing. That's because the eggs never seem to break. Anyway, the easiest thing that I recommend for you to do with this company is just order one of their pillows and see if you like it. I like them, although I've only experimented with one of their pillows, and I'm waiting for a second one that I think might be a better fit for me so I can really decide if I want to go full steam ahead on this company. Right now, I've got about $40,000 riding on this company. This company just went profitable, and it grew 68% in the first quarter of this year compared to last year. If they keep up this pace and grow at just 50% this year and next, they could hit $1 billion in revenues by the end of 2021? Now that's insane. It might end up taking a little bit longer than the end of 2021. I mean, they just did 122 million in one quarter at the beginning of 2020 here. That works out to an annual rate of about 480 million in revenues. So 1 billion is not too far-fetched. But if they reach 1 billion in revenues, that should leave them with an earnings of about $4 to $5 per share. With those earnings on a company that's selling for 23.86 cents per share, this company could easily be selling for $80 to $100 per share in the next 2 years if they keep their sales up. However, there's a big risk with this company because it's a pillow and mattress company. If people start hating this company or their products start sucking or they saturate the market, and nobody might want them anymore. And if the product's so good, people might not have a reason to come back and keep buying more pillows and mattresses. I don't know. We'll see. I'm optimistic. I've invested about $40,000 into Purple. I plan to invest more in Purple and Rocket Mortgage. I'm holding more steady on Peloton. I'm holding more steady on Lemonade right now. But that does bring up the next company. And I already said it, Peloton. So those are my opinions on Purple. Let's get into number 4, Peloton. Peloton is currently trading for about $67.91. Peloton is a company that I'm personally very excited about, but I am worried that it could be a fad, and that would be very bad. Hey, that rhymes. I personally have a Peloton bike, but I do find that I spend more time on my walking treadmill than I do my Peloton bike because I can work on my computer. The quality of the bike is amazing, but the company is currently losing money. Interestingly, though, their next earnings cycle will end, well, their next earnings release will be on September 10th. Now, to me, this is going to be a very interesting release, and here's why. Usually, about 50% of the company's revenues go to making the bike. Then another 50% go to commissions for salespeople in malls to sell the bike. However, a lot of these commissions aren't happening right now because a lot of the bikes are being sold online because the company basically went viral during the pandemic and nobody's going to malls. So rather than selling these bikes through expensive channels like using commissioned salespeople in malls, they could sell them online thanks to viral pandemic advertising. Now, how long is that going to sustain itself? We don't know. But I think this means we could see a banger of an earnings report next time Peloton releases their earnings on September 10th, which is my dad's birthday. And if this company can grow without commissions, then the profit per bike sale for this company is going to go through the roof. It also helps them insulate themselves against other bike competitors, which most aren't even keeping up with Peloton's sales numbers. For this reason, I'm big on Peloton. Like Lemonade, I have somewhere between $170,000 to a little over $200,000 in this company. I'm not adding to my position to Lemonade and Peloton right now. Instead, I am adding to Rocket Mortgage and Purple, as I did mention in the last segment. Now, here's another one, though, and I'm slowly considering adding back into, okay, all right. Number 5, Dave & Buster's. Now listen to this, okay, before you skip this section, listen to this. Many of you know that I'm gung-ho about Dave & Buster's. I made a full detailed breakdown of their company in June, and I got spanked by the second wave or the continuation of the first wave. I don't care what it is, I got spanked. I bought the company at $16 to $19 per share. It's now at about $13.59 per share. Not great. Here's the quick and dirty on what I think about Dave & Buster's right now. Chuck E. Cheese went bankrupt. If Chuck E. Cheese is forced to close its stores, guess who's going to fill the void? Dave & Buster's. Now, Chuck E. Cheese might come back, but if it takes multiple years for Chuck E. Cheese to come back, Dave & Buster's is going to saturate the market, and Chuck E. Cheese is going to get squeezed out. Dave & Buster's also has smaller store models that are easier to open, quicker to open, and are much more profitable than the bigger stores. This pandemic could be a beautiful opportunity for Dave & Buster's as long as they don't go busters. Heck, if Dave & Buster's survives, guess what's great? Malls are going to be desperate to attract customers. And guess what Dave & Buster's does? It attracts people to destinations, whether they're plazas or malls. Dave & Buster's could easily move into every single mall in this country as a way to get malls to give Dave & Buster's discounted rent to get Dave & Buster's coming in, which is a huge opportunity for Dave & Buster's, and it's a great boon for malls to actually lure people to the mall. You want to go to Dave & Buster's? You got to go to the mall. It would be a way to breathe life into an industry that's dying, the mall industry. Now, I also hear that Dave & Buster's is casting people for a TV commercial, which might be them blowing their budget, their marketing budget before they go bankrupt, or they don't plan on going bankrupt. I don't know. Dave & Buster's, like I said, could end up bankrupt, but if it survives, which I think it will, you've got a great company here that could 4x, probably 3x in value. You've got BlackRock, Jefferies, and Vanguard backing over 40% of the shares held by this company. And I think Dave & Buster's, because of that, not only has staying power, but it has really the ability to do very well once we go back to normal, especially if we get a vaccine before they go bankrupt. All right, I got the Dave & Buster's part out, okay? I really hope they don't go busters. Anyway, let's now talk about Redfin. Redfin. I first advocated buying Redfin back in March when I bought this stock for about $10 per share. It has since over 4.5x'd in value. I love this company, but I also love to hate them because I'm a real estate agent and they want to put me out of business. I think they are going to be a massive millennial disruptor in real estate, and one of the big reasons I'm investing in them is because the bigger they get, the harder it'll be for the average real estate agent, and they're growing fast. Now, I still encourage people to be real estate agents because there's plenty of money to be made out there. And hey, it's just a company to hedge against. You know, if you're a real estate agent, buy some Redfin stock, okay? That's always what I've thought. Real estate agent, buy Redfin stock. Anyway, Redfin was hurting during the pandemic, but they survived very well and their losses actually shrunk. Real estate did very well during the pandemic, but Redfin did shut down for quite a period of time and they started laying people off. However, because of this and sort of years of losses, they haven't been profitable yet, they're gonna have some sweet tax advantages going forward. When this company shows its first $10 million profit per quarter, and we annualize that to about $40 million of profit in the future, we're looking forward, that'll be about 40 cents of earnings per share, which means that today this company is trading for about 112 times future earnings, which is insane. It's very high. I'm not adding to my Redfin position right now. Like when Redfin fell to $36 last week, I added to Redfin. And I told all my course members I was buying Redfin because I thought it was oversold. Well, here's the scoop. Redfin has less risk than Purple. Purple is more risky, the mattress company, right? It's more risky than Redfin. Redfin has less risk than Rocket Mortgage. Actually, Redfin competes with Rocket Mortgage because Redfin just released a lending division and they just completed their first refinances. Redfin's also not going to be a potential fad like Peloton. And this definitely isn't anywhere near as risky as Dave & Buster's. Now, along with these, I'm of course still buying my favorite stocks like Tesla, Apple, and Amazon, but these are my top picks, and the reasons I love them. So thank you so much for watching this. Good luck. I hope all of these stocks skyrocket past $100 in the next few years and beyond. Hey, the sooner after this video, or the sooner after I post this video, the better, because it'll make me feel very special, but no guarantees that that's going to happen. They could all literally half in value before any of this stuff comes true, and Dave & Buster's could go bust. I appreciate you watching. If you found this video helpful, please consider sharing it. And folks, until next time.